Welcome to Stock Talk with Nico Criticos. Today we're going to do some stock analysis for Intel stock. I'm going to show you why I'm not interested in buying this stock at the moment. Now, last year in November, I was picking up some shares because it looked pretty cheap, and I was buying it at $28 a share. But then a couple weeks went by, I ended up selling at $31 a share, and I'm going to walk you through why I believe this is not that great of an opportunity. So, Intel is one of the world's largest semiconductor chip manufacturers, right? Here is a graph comparing AMD and Intel in CPUs worldwide. And what you're going to see is really from about somewhere around here, 2016, 2017, AMD was taking away market share from Intel. That's why Intel is, even though they have significant market share, they're still a very dominant player. That's been going downhill the last 5 to 10 years. And the other thing about this company is they recently just got, the White House gave out, pretty much invested a bunch of money to compete with China, pretty much. The White House wanted to invest in American chip manufacturers to help boost production. So Intel is benefiting from that. That's one thing to take note of. But if we go ahead and look at some of the metrics here, we're going to see that revenue has been weak. It barely is growing, maybe 1% a year at best. If we look at net income, it's even worse. It's really been flat, if not, it's pretty much been flat. I mean, we're talking 25 years ago, they were doing in this $7 to $10 billion range, and that's where we're at as of last year. So that's been their problem. They have not innovated fast enough compared to these other companies. Now, we're going to look at the P ratio, and I'm going to show you why I believe this is not a good buying opportunity. So here's where Intel normally trades, right? Somewhere between a 7 and a 12, pretty much, or a 6 and a 12. We can say maybe the average is 10. 10 would probably be a fair PE traditionally for this company. Well, for last year's earnings, no, let's do it all based off of this year's earnings. For this year's earnings, that would mean the stock should trade at $3, right? $3, because they're only doing 36 cents of EPS. For next year, which makes a little bit more sense, this is probably closer to what they should be doing, 1.6 times 10 is 16. So it should be a $16 stock. So even if we go off of next year's metrics, the current share price divided by next year's earnings means you're paying 19 times earnings for this company. This company doesn't trade at 19 times earnings. It trades at a 7 to a 13. I mean, it's been 19 one time, and it didn't last for long. It came right back down and reverted to the mean. That's why I don't think this is a good opportunity. Then we're going to go down a little bit more. We can look at, is the company innovative? I put no. Do they have strong market share? Yes, they do have strong market share, although they're losing market share. Their return on invested capital is good. If we want to scroll down here, we can see that it's above 10%. That's really all we're looking for. 3 years of growing equity without goodwill. Yes, they've accomplished that. They actually have a lot of equity. Let's go to the balance sheet. This is something I really do like about the company, actually. Relative to their market cap, their balance sheet is strong, and they have a lot of equity. So let's go here. Not the best internet speed today, but we can see that equity is $103 billion. Let's see, can we go to the most recent quarter? Yeah, $100 billion. Intel is only a $125 billion company. So you're getting a ton of equity for what you're paying. And that ratio of assets to liabilities is also very strong. They have $100 billion more in assets than they do in liabilities. That is one of the keys here. That's one of the highlights for this company. The share count is decreasing. How I just said, balance sheet's great. Profit margin's 12%. That's solid. The cash and receivables is respectably higher than their average annual income, probably being that they keep building up that balance sheet stronger and stronger, but they're not actually making more money. They're making the same money they were making 25 years ago. Now, here's another thing I don't like. So the company is over 20 years old. Their free cash flow is not growing. That's one of the biggest red flags. But they said the dividend was fine last year. Then a couple weeks later, the CEO comes out and says, no, we're going to have to cut it. Our cash flow is not strong enough. So there's a lot of red flags here I don't like about this company, along with the PE ratio being overvalued.